And we wanted to take a look at the state of U.S. equities, which have pretty much taken a beating since the start of the year after seeing record high after record high. Treasury yields are sitting near two-year highs as the future of Federal Reserve policy remains in focus, with investors keeping an eye on when the nation's central bank will make its first move toward raising interest rates, which have been sitting near zero.
So let's take a look at the numbers here. The Dow is down about 3.5% since January 1st, while the S&P 500 has lost more than 4.5%. But the biggest drop, well, it's been with the tech-heavy NASDAQ, which has fallen more than 8.5% since the 1st of January and down nearly 10% since highs in November, putting it on the brink of officially entering correction territory. So let's go ahead and take a look at what markets are doing and if this is something we could expect to continue with Michelle Schneider. She's the partner and director of trading research and education with MarketGauge.com. Michelle, I want to start with markets dropping overall over the last couple of weeks. It seems everyone is chalking this up to fears over rising interest rates, but all signs point to March as the earliest point we might see the Fed hike rates. What are you seeing here?
So I want to add one other index to the list of the ones that you just mentioned in terms of correction, and that would be the small caps, which have now fallen probably more like 15%, and they really got the ball started, and also we're in a trading range since February 2021. So I mention that because what we're really seeing now is a test of a lower end of some of these trading ranges that were established in early 2021. And so why is this happening? Partly, yes, the Fed is definitely partly responsible to that, but everybody, I think, in the back of their minds knew it was inevitable that we couldn't keep 0% rates, especially since we're seeing these inflation numbers. And that's the second problem, is the inflation numbers now are becoming persistent, where we talked about it on this show a year ago. Now, all of a sudden, it's mainstream on everybody's lips. Labor is still a concern, supply chain is still a concern. And then on top of that, you had $800 billion worth of corporate buybacks that helped boost the market. You've had something like $25 trillion worth of new retail investor accounts opening. And then from a geopolitical standpoint, now you have the Russia-Ukraine situation. So you put this all together right now, the market is heavy. Everything was overvalued as well. So it'll be interesting to see if we find a floor near these more recent lows that we're seeing right now.
Yeah, definitely, especially as we see that Fed policy start to kick in. Now, as we've seen, tech has been the biggest loser recently, with the NASDAQ on the cusp of correction territory being down nearly 10% from highs in November. So is this about a transition out of pandemic plays? I mean, why are tech stocks taking the brunt of the sell-off?
Again, there's so many reasons. So for one, let's talk about the growth area and the corporate buybacks. That was huge, and cyclically, these things come to an end. Interest rates definitely are going to impact tech stocks, and they don't like higher interest rates, so they're fearful of that. Then on top of that, if you just take something like the ARK fund, which was the disruptive technology, it was kind of almost a harbinger of what was going to happen with the overall tech, because a lot of the companies that are in the ARK fund have no balance sheet. So they weren't really the growth companies that Cathie Wood anticipated they would be. And then also we have earnings on tap now, and a lot of the expectation for the earnings on some of even the big ones are looking like they're not going to be as robust as they were. So you put this all together, really only certain tech companies could survive this type of environment, and even those are being tested right now, like an Apple, for example.
Absolutely. Now, with all of that in mind, when the Fed does actually take these steps to aggressively pull back the easy monetary policy, do we anticipate that tantrum we had kind of expected when the central bank started the taper of quantitative easing?
Well, some people will say that it's being priced in right now, and I think that's a legitimate concern. I think a bigger concern might be if they actually do raise rates, can it be sustainable? Because on top of everything else we just talked about, we do have a shrinking economy right here that is very much counting on the end of COVID and counting on an infrastructure package and just counting on basically things getting back to some relative normal with growth. So that may not be the worst problem of them raising rates. It would be, can they continue to do so? And that would not be considered healthy if they can't.
And it's interesting that we talk about, oh, it's priced in, but that just really means they overreacted ahead of time before anything happened. Michelle Schneider of MarketGauge.com, thank you so much.
Thank you.